all that really will do is guarantee that you lose money. Any money that that you voluntarily give to the government by creating a taxable event is money that's taken out of your portfolio at a guaranteed rate. So whether you're at
Well, welcome to the 20th edition of Barnes Quarterly. I'm Stan Barnes and
Eddie Hatch.
And hope everybody's having a great summer out there. It has been pretty fast and furious, and I'm sure everybody knows extremely hot. Both Eddie and I, since our last edition, have had a chance to take a little time off. A couple of weeks ago, I was checking in on a client out in Montana near the town of Twin Bridges, and got to do a little fly fishing there in southwest Montana with our friends at Rack and Reel, the outfitters that do both fishing and elk hunting. And then I went east over to Gardner, just outside Yellowstone Park, and hooked up with a fraternity brother of mine and spent a little time on the Yellowstone River. But I love that state. It was not quite as cool as it typically is, but it's still a nice break from what we've been feeling here in Tallahassee. Eddie, you took some time off with your family. What?
Yeah, mine wasn't quite as eventful. I just took a little time and went over with the family. We were at the beach, so I was braving the heat, trying to stay in the shade as much as possible. But I typically go over with my sister's family and my parents as well.
Well, you're in a little bit different season than I am. Your kid's a little younger.
Yeah, turn the kids loose on the beach.
Which is a good segue to it's going to be a big year for the Barnes family. We both of our children, Travis and Colson, are going to be getting married this year. Travis in November outside of Atlanta, and Colson, who lives in Nashville, she and her fiance are going to be getting married in New Orleans over the Christmas holidays. So obviously the stress levels are escalating quickly around our house, but we're absolutely delighted with the partners that both have chosen, and feel very fortunate with that. On a business note, we've had a couple of we've had one intern who was with us earlier in the summer, Gina Whitten, who is at FSU majoring in finance, and she came in and did an outstanding job. And our second intern, Fletcher Sheffield, will be joining us on Monday, and he comes to us from the University of Georgia, which so we're balancing things out. Eddie the Gator over here is not really happy about that, but so sorry we didn't fit a Gator in this summer. Maybe next year, but at any rate, and then we also you all will be getting an email with a video from us. We worked with Marshall Moyle at Megafauna Filmworks on really just trying to communicate sort of what our business values are, and how we operate, and what's important to us with our client relationships. And so we didn't feel like we were doing a great job at promoting that. And so we welcome your feedback when that does go out. We just got word that that's been approved by compliance, so should be released here fairly soon.
As usual, we have Chris Zaccarelli on with us today as well. We're covering the second quarter, and as we move into the third quarter, what his thoughts are on the market and the economy, and I think we're going to have a good discussion with him today.
I was sitting in on a webinar by one of our partners, investment partners here yesterday, and the commentator who was leading the discussion made the comment that there are decades when nothing happens and weeks where decades happen. And that seems to sort of be representative of what we've had here in the last couple of weeks with Obviously, we're all aware of the presidential campaigning that's underway right now. You had the assassination attempt on Donald Trump. You had Biden stepping down from running for a second term, and you have Kamala Harris that's emerging apparently as the Democratic nominee. So lots going on. In addition to, the crash we had a week ago, Friday, with the CrowdStrike snafu that was triggered by an update that they were implementing that kind of sent everybody reeling, airlines, financial institutions, et cetera. So with that as a backdrop, Chris, what's going on out there?
Yeah, to your point, we've seen quite a few things that haven't happened in decades, whether that's an assassination attempt, whether that's, an incumbent deciding not to run for reelection. These are things that you don't see too often. So, history, of course, is being made, right before our eyes. And I guess that's how it always is. From a market's perspective, things have actually been much more calm. We've been through a lot, whether that's in 2020 or even a little bit in 2018. And of course, looking back to 2008, which is the biggest market event of our lifetime, things are a lot more, proceeding in a lot more calm and in a little bit more traditional way. Really from, where I sit, I think what's most important is just understanding that the Federal Reserve, which raised rates as quickly as they did and as high as they did in order to combat inflation that was heading towards double digits, the rate of increase in prices has come back down now to the 2.5% to 3% range. Their target is 2%, so they're not done fighting inflation in terms of the rate of increase, but their fight has largely been achieved in terms of bringing us back down from the 9%, year over year numbers that we saw just a couple of years ago. So what that means for markets is that the Fed, rather than raising interest rates, which they've stopped doing, and keeping rates at the current levels, which is what they've been doing up until very recently, they now are in a position to start cutting interest rates. So we're heading into a Fed meeting next week, so that'll be the end of July. They're likely to leave interest rates unchanged. If they see something in the data that none of us see, it's always possible they could cut, but that's not something that they've communicated. But it is much more likely that we get at least one rate cut before the end of this year, and we might even get two. And if we get two, it's possible to get one right before the election in September, and then maybe one after the election in December. So what that means for markets is that both stocks and bonds have an opportunity to keep rising in price from here. Stocks will keep going higher in price. We all know what that means. And then for bonds, you could see interest rates going lower because rates move opposite bonds. So that's the environment we find ourselves in. And it's one that's a much more normal environment, despite all of the very dramatic things that we've seen over the last few weeks, which you mentioned in your original question to me.
Listening to some of the people discussing the potential for interest rate hikes or decreases, they say that most of the time they try to hold off on doing that in or prior to an election to not sway the election. Do you see them trying to wait till after the election, or do you see it happening potentially right before an election happens?
Yeah, the Federal Reserve talks a lot about their independence, trying to stay very separate from what's happening from a political point of view. And I think they've largely done that. I think there's been a lot of presidents who've tried to pressure the Fed, and that's Republican and Democratic presidents who've tried to do this. And so, most presidents would prefer interest rates to be lower in order to help the economy. In this particular case, the Fed has been communicating so much over the last couple of years that you can really see they haven't done anything drastically different than what they would otherwise do. So at least for myself, and I think most market participants, again, taking your complete political lens off, removing your biases as best as possible, it really does seem like the Fed is very singularly focused on bringing inflation back down to that 2% target. They've largely done that, although not completely. And so I think they feel like interest rates are relatively high for an environment where inflation does appear to be coming back down. So in that case, it does make sense to cut. To your point, the timing is important. There is a Fed meeting in November. It's right around the election. And so I would argue they're going to just hold off on doing anything right around the election. But, they've been communicating that they wanted to lower interest rates really since the end of last year. And I would argue they would have already lowered interest rates well before this time if inflation hadn't surprised them in the first quarter of this year. So I believe the Fed has, at least for the past call it, 14, 15 months, been looking to cut interest rates. For the past year has been looking to cut interest rates as soon as possible. And so I think September is a likely time for them to begin cutting interest rates unless the data stops them from doing that. But regardless of whether they cut 25 basis points in September or they don't start their first cut until December, they've communicated that that's the direction they're heading in. So I don't see anything that they're doing, whether it's September or December, as necessarily having an impact on the election per se. So I think as far as people saying the Fed is getting involved in the election, I would disagree in this case. I think they've done a really good job about just communicating their goals, regardless of what the calendar is.
For the last, seems like several years, much of the growth in the market has come from the mega cap tech names. And it looks like we're, at least over the last couple of weeks, starting to have a rotation out of that into other parts of the market. Can you talk a little bit about that?
Yeah, absolutely. A lot has been made over the fact that the largest companies in the U.S., largest companies in the S&P 500 have been responsible for the lion's share of the gains in terms of stock prices. And so I would always just temper that thought with the idea that they've also had the lion's share of profits. So to some extent, you really are seeing the fundamental outperformance of those companies translate into actual stock market performance. The problem becomes twofold. One is that even though the profits have been increasing at a relatively high rate, and even though those companies are responsible for a majority of the profits, well and above what all the rest of the companies, the S&P 500, are doing, at some point you overshoot. And I think we've seen that point where not only have the stock prices of those companies increased more quickly than their profits has been increased, you could argue that the percentage, the concentration of those large companies in terms of the total stock market gains has also been higher than what you'd see in terms of the percentage of their profit gains. So to some extent, the market is following the fundamentals, but it appears to be overshooting. And so what we've learned from market history is that markets typically will overshoot to the upside and to the downside. So I'd argue we've for some time now been overshooting to the upside, where those companies, stock performance of those large companies potentially have outstripped what they've actually done on a fundamental basis. And so no one knows when that trend will reverse. You just need to identify the fact that you're in that type of a situation where the stocks are expensive given what they've done. And so I think we're at that point. So over the last few days, we've seen a little bit of a pullback in those stocks. But as we're recording this podcast right now, they've already had a bounce back. So I would expect that the outperformance that you've seen from these large tech companies will likely continue until you see the economy turn. However, even though those companies are still likely to keep seeing their stock prices increase and not necessarily see a meaningful drop in prices across those companies, we're at this point now where the difference between those large companies and all the other companies has gotten pretty stretched. And so I think that's an opportunity for those investors, ourselves and other investors, when you're putting new money to work, or at least looking to take some profits. To me, the risk reward continues to look better and better outside of those companies rather than just concentrated very heavily within those companies. And so I think that's why you're starting to see a rotation, so to speak, a move slightly away from those larger companies towards some of these other companies. And that's something that I expect will continue, again, as long as the economy continues to expand. If and when we head into recession, you'll see a drastic change in market leadership, and that's typically when you always see it. But it's anyone's guess as to when that will happen. For right now, the coast seems relatively clear, and that's always the case. It's always darkest before the dawn, and vice versa. So I say that very cautiously. But for now, looking at the economic data, whether that's the GDP numbers that just came out the day before we recorded this, or whether you're looking at unemployment, all those numbers are at very healthy levels. And so we don't seem to be entering into recession at this point in time. And so for that reason, I would expect this rotation to continue, where it's not necessarily the technology companies going down in price in a sustainable way, but you're seeing the rate of their increase, the stock price appreciation that we've seen over the past year and a half, that should slow, and it should definitely slow relative to the opportunities within other sectors within the S&P 500.
Chris, I'm going to read a statement that I'd like for you to comment on, but essentially, this time of the year, we have clients and prospects that are concerned about the fact that we've got a presidential election coming up in November, and they're like, well, what should we do? Don't things get volatile during elections? Should we pull out and just wait for that to be over with? Or, how should we respond to the uncertainty that we're going to see until someone is elected president? So this, again, was on that webinar that I was listening to, but the statement was made, a $1,000 investment in the S&P made when Franklin D. Roosevelt took office would have been worth over $21 million as of December 31st, 2023. During this time, there have been 8 Democratic and 7 Republican presidents. So, this is kind of an indicator that I think that the market continues to roll on, and so when the volatility hits, some people say, well, why don't we just pull our money out of the market and sit on cash for a couple of months, and then when somebody gets elected, we'll jump back in. Can you kind of comment on the first statement about the growth of that the money since FDR was president, and then also the proposed strategy of jumping in and out of the market?
Yeah, absolutely. And I think both of those are really interesting observations and really good points. And so taking the first one, absolutely. One thing that we've seen over the past century, if not longer, is that American companies, especially, they're very dynamic, they're very adaptable. And so for companies, there's clearly certain policies that are better for companies than other policies. There's certain tax regimes that are better for some companies versus other companies. And so the situation on the ground is always changing. And depending on who's in power, whether that's the president, whoever controls the House or the Senate, there can be advantages in the short run, one way or the other, to certain companies over other companies. And it's worth being aware of that. But in general, we've seen time and time again that companies continue to adapt. And ultimately, it matters much, much less over the long term, which party is in power in terms of Congress or the president. And it matters much more about the management team, the products, the marketplace. All the things that you would expect are most important about examining companies. And so that's what we try to focus on. We realize that in the short run, politics can have a very big impact on companies, but in the medium and long term, and that's what we should all be focused on, especially as we look forward to retirement and beyond, whether that's living off of our portfolio right now or growing our portfolio to a place in the future where we can live off it in the future. What matters most is making sure that you have the right companies in terms of the ones that are operating well, have a diversified mix of those companies so that as economic cycles change, as business cycles change, even as political cycles change, we're not caught off guard. But ultimately, it's really time in the market as opposed to market timing that's proven time and time again to give you the highest possible return. And so I think, some of the facts that you shared, those numbers and statistics really, illustrate that very, very well. To us, that's the most important thing. And that's the one thing that you can really count on as opposed to predicting the possible result of an election. As far as in the short run, pulling money out, waiting for time to pass, there's a couple problems with that. First of all, if you're talking about money that are in taxable accounts, chances are you have a lot of unrealized gains. And just by pulling money out of the market, you're going to realize a lot of tax consequences. All that really will do is guarantee that you lose money. Any money that you're forced, that you voluntarily give to the government by creating a taxable event is money that's taken out of your portfolio at a guaranteed rate. So whether you're at a long-term capital gains plus, Medicare Medicare surcharge of 23.8%, or whether you're taxed at ordinary income, that's a guaranteed loss to your portfolio once you crystallize any taxable gains that are taxed. But even in retirement accounts where the tax consequences don't matter as much for making short-term decisions, a lot can change in markets. And so markets are very dynamic. The most difficult thing about markets, even when you don't take taxes into consideration, is that they can move very quickly. You can look over time and see the market will average 7% or 9% or 10% on average. But if you look really, really closely, a lot of those gains will happen in a very short period of time. And so to me, it's just too big a risk to have your money on the sidelines waiting for a volatile time to pass in order to jump in, because a lot of times it is during those most volatile, during those most uncertain times that the market makes its biggest gains. So as far as my own money and what I would caution to others is leave your money in the market, make the right decisions at the right time in terms of when you're taking money out for spending purposes. But if you're trying to outthink the millions of people who are in the market, I think it's been proven time and time again that that's something that's really, really difficult to do. That's not something that we think is repeatable or a sustainable advantage. So rather than taking that chance with your money, I think it makes a lot more sense to just stay invested and let the power of compounding do the work. Again, back to your original example of $1,000 invested, back when FDR was president.
Great. Well, thank you very much. Well, really appreciate your time this morning. And I guess the next time we convene, maybe the path will be clearer in terms of politically here in the country and hopefully economically too. So again, thank you for your time this morning and look forward to talking in the future.
Thanks, Dan. Always great talking with you and your clients, and I appreciate the opportunity to share our thoughts.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.